Welcome back to the Deep Dive. And today we're looking at a situation that is honestly pretty wild.
Oh, yeah.
Yeah. We're looking at Mercer International. Ticker symbol is MERC. And, they just posted their Q2 2026 earnings.
Right.
And they posted a $76 million net loss for Q2, which is, rough.
The big number.
It is a big number, but the real story, the thing we're really digging into today, it isn't actually on the income statement itself. It's happening over in Europe.
Right, yeah.
Specifically, we've got the German government actively subsidizing people to burn high-grade pulpwood in their home fireplaces, which is, it's completely short-circuiting the European supply chain for these guys. So, okay, let's unpack this.
Let's do it. And, they're doing this subsidizing, right, as we have these massive geopolitical choke points that are just squeezing global freight and energy markets across the board. So we are looking at, basically a classic fundamental dislocation. For retail investors who are, analyzing Mercer right now, the underlying mechanics driving these specific earnings, they are just critical to understand.
Absolutely. So let's hit the raw data first.
Okay.
Because the miss here is severe.
Yeah, it really is.
So that $76 million net loss, that translates to $1.13 per share.
Right.
And what's scary is it's accelerating down. Because in Q1, the loss was $52 million.
Mm-hmm.
So we're moving in the wrong direction fast. And then if you look at operating EBITDA, that swung from a positive $8 million in Q1 all the way down to a negative $21 million this quarter.
Which is just a brutal swing.
Oh, totally brutal. And the bleeding, it's pretty concentrated. You've got negative $12.7 million in the pulp segment and then negative $8.2 million in solid wood.
Yeah.
But, and I know you want to talk about this, the real anchor that's just dragging the balance sheet down right now is this $29 million non-cash inventory impairment.
Right. Yeah, that's the big one. What's fascinating here is how quickly the cost-price spread just completely inverted on them.
What do you mean by that exactly?
Well, so out of that $29 million impairment, $26 million of it is sitting directly at their pulp mills. So they are running these facilities, right? They're keeping the lights on, the machines are running, but the unit economics are totally broken.
Okay.
The cost to actually harvest the wood and process the fiber, it has entirely eclipsed the current spot market price for the finished pulp that they sell.
Oh, wow. So it literally costs them more to make it than they can sell it for.
Exactly.
Mm-hmm.
And so under standard accounting rules, GAAP, they had to take that inventory they have sitting around and mark it down to its actual net realizable value.
I see.
Because you can't carry an asset on your books for, say, $100 if you can only sell it for $80 in the real world.
Right. That makes sense. It's essentially acknowledging the reality of the market.
Exactly. They have to swallow that loss right now on paper.
Which brings us directly to, why those production costs spiked so aggressively in the first place.
Yeah, the fiber costs.
Right. Looking at their German operations, management recorded a 7% increase in fiber costs, and that's just since the first quarter, just quarter over quarter.
Yeah.
I want to use an analogy here because when I was reading through the transcript, the dynamic just seemed wild to me.
Oh, it's totally wild. Let's hear the analogy.
Okay, so it's like, imagine you're trying to run a commercial bakery, right?
Yeah.
You make high-end breads or whatever.
Sure.
But suddenly you're trying to buy flour and you're competing for that flour with people who are buying it just to take it home and throw it in their fireplaces for heat.
Right.
Like, how does a highly engineered pulp producer, this massive industrial operation, get squeezed by everyday residential firewood demand?
Well, it comes down to this perfect storm of macroeconomic pressures, and those are colliding head-on with very localized government policy. Yeah. So management laid out the facts quite clearly on the call. First, you have to look at the war in Ukraine. That has effectively halted the inflow of Russian wood into the broader European market.
Right, because of the sanctions and the supply chain breakdown.
Exactly. So that instantly, almost overnight, shrank the total addressable supply of fiber in Europe. There's just less wood to go around, period.
Less wood for everyone.
Right. And then, simultaneously, you have the conflicts in the Middle East.
Oh, right. The shipping lane issues.
Exactly. That is driving significant inflationary pressure across both freight, because boats have to reroute, and energy costs. So now it costs more to move the little wood you do have, and it costs more to power the mills to process it.
And then, on top of all of that, the German government steps in.
Precisely. This is the kicker. The government in Germany is directly subsidizing wood-burning home heating solutions.
Which I guess on paper sounds like a green initiative or a way to help citizens with energy costs, but it has this huge ripple effect.
Yeah, exactly. So you have this historically shrunken total supply of wood, right?
Yeah.
And now Mercer, who is producing specialized northern bleach softwood kraft, which they call NBSK pulp, they are forced into a bidding war.
A bidding war against who?
Against pellet producers. And these pellet producers are heavily subsidized by the government to buy that exact same raw material, chop it up, and burn it for energy.
Hence the flower in the fireplace analogy.
Okay,
because
correct.
the pellet producers, they can just bid up the price of the raw fiber to the moon because the government subsidies insulate their profit margins.
Right. They don't care what the raw wood costs because they're getting a handout to cover the difference.
But Mercer has no such protection.
None.
Zero. Wow. And they're facing sluggish end market demand at the exact same time. Like, people aren't exactly clamoring to buy NBSK pulp right now.
No, the market is super soft.
Right. I noticed in the numbers, their average NBSK pulp realizations, what they actually sold it for, that dropped to $682 per ton this quarter.
Yeah.
So their costs to go up 7% and their selling price is dropping. The math just completely breaks.
It absolutely breaks.
Yeah.
You can't run a business like that.
So how are they reacting? Because they can't just keep burning cash like this indefinitely.
Well, they're reacting by drastically reducing capacity, specifically at their Torgau facility.
Okay, what are they doing there?
So they already cut 100 contractor jobs back in July.
Wow.
And management said they have 250 more cuts scheduled by Q2 of 2027.
That's a massive reduction in headcount.
It is. They are structurally shifting that entire mill from a 4-shift continuous operation, where it's running 2047, down to a 3-shift system.
Which means they are just leaving production on the table.
Right. It's a mandatory capitulation to the current economics. They're basically shrinking their footprint to match the weak European demand environment.
Just battening down the hatches.
Basically. And they're also pivoting their product mix toward dimensional lumber for the U.S. market.
Trying to find anywhere that has better margins.
Yeah, they're just trying to patch this together to reach cash flow break even by 2027.
Well, okay, here's where it gets really interesting because, you say break even by 2027, but 2027 feels like a very, very long way away when you look at their immediate liquidity risk right now.
Oh, absolutely. The debt is the elephant in the room here.
Yeah. So for the listeners, in the earnings report, they had to reclassify their revolving credit facilities. They moved them from long-term debt to current liabilities,
Right.
which is a huge accounting red flag. And that triggered what auditors call a going concern disclosure.
Yeah, and anytime you see the words going concern in a filing, you need to pay attention.
Exactly. It basically means the accountants are saying, hey, we're not entirely sure this company is going to survive the next 12 months.
Right.
And the numbers back up that fear. They only have $191.7 million in total liquidity right now.
Which burns fast.
Really fast. And they are anticipating a covenant breach on their leverage ratio by Q4 of this year.
Right. And this raises an important question, right? Which is, what is their actual runway here?
Yeah. How much time do they have?
Well, when your EBITDA goes deeply negative, like we talked about earlier, your leverage ratio just blows up.
Because the ratio is usually debt divided by EBITDA.
Exactly. So if EBITDA shrinks or goes negative, that ratio skyrockets and you violate the terms of your loan.
Got it.
So management confirmed on the call that they actually secured a waiver from their banks through September 30th for these German revolvers.
Okay, so a temporary hall pass.
Right, a temporary hall pass. But after that September 30th deadline, they project a breach.
Wow.
And that instantly converts all that long-term debt into an immediate short-term obligation, meaning the banks could theoretically demand all their money back right now.
Which they obviously don't have.
Exactly. Now, management said they are actively evaluating, quote, strategic alternatives, unquote, with their 2028 and 2029 note holders.
Right.
But, as an investor looking at this, you have to realize they're negotiating from a position of severe weakness.
Because the bondholders know Mercer has its back against the wall.
Exactly. The bondholders are holding all the cards.
Okay, so I completely understand the panic over the debt. It's bad. But I do want to push back on the pure doom and gloom for just a second.
Okay, let's hear the bull case.
Well, it's not a full bull case, but they aren't just sitting still letting the ship sink.
Sure.
They have this initiative, they call it One Goal 100. It's a cost-saving program, and it has already stripped $54 million in structural costs out of the business just since April 2025.
Right, which is commendable. That's real cash.
It is real cash. And more importantly, I think we have to look at their mass timber segment. Because this was a bright spot in the call. They are sitting on a $151 million backlog right now. And here's the crazy part. 70% of that backlog is driven by data center hyperscalers.
Yeah, that is the single most interesting data point in the entire report, in my opinion.
So walk us through that. Why are the tech giants buying up all this engineered wood?
Okay, so if we connect this to the bigger picture, the mass timber pivot is actually legitimately compelling for Mercer. Because you have these hyperscalers, right? The big tech companies. They are in an absolute arms race to build AI infrastructure and massive data centers.
Right. They need buildings. They need them fast.
Right. But at the same time, they face these massive, mostly self-imposed environmental mandates. They've all made these big zero carbon pledges.
Oh, right. Like being carbon negative by 2030 or whatever?
Exactly. Now, traditional building materials, steel and concrete, they are incredibly carbon intensive to produce. They emit a ton of CO2.
Yeah.
But mass timber, which is highly engineered wood, things like cross-laminated timber or CLT, it actually does the opposite. It sequesters carbon.
Because trees absorb carbon while they grow, and then it's locked into the wood.
Exactly. You lock the carbon into the building itself. Plus, CLT is prefabricated in a factory. So when it gets to the construction site, it allows for much faster assembly times than concrete.
Oh, wow. So they get their AI data centers online faster, and they get to claim carbon offsets at the same time.
Yes. It's a massive win-win for big tech. And for Mercer, that represents a high-margin, growth-oriented revenue stream that is completely decoupled from the volatile, pulp commodity market we were just talking about.
Okay, so that is a really fascinating lifeline they have dangling out there.
It is.
So bringing it all together, what does this all mean? If you're factoring in the AI data center lifeline, which sounds great, against this looming, immediate liquidity crisis with the banks, what is the final talk ticker's verdict for a retail investor who's looking at this stock today?
Well, I have to say it is definitively bearish for the short term.
Bearish, okay.
Yeah. I mean, look, the mass timber narrative is excellent.
Yeah.
It really is. And the internal cost cuts they've made, that $54 million, that's real progress.
Right.
But as an investor, you just cannot ignore the immediate cash burn. Management admitted right on the call that the German pulp mills are negative cash right now.
Right.
They said they need a $35 million to $40 million structural improvement just to hit break even on cash flow.
Just to stop bleeding, not even to make a profit.
Exactly. And when you add in the fact that they have 40 days of major maintenance scheduled for Q3.
Oh, yeah, I saw that. That's going to sideline, what, another 42,000 tons of production?
Right. So they aren't even going to be running at full capacity in Q3.
Right.
So time is just heavily against them right now.
So the actionable takeaway here for the listener is, until Mercer officially announces that they've successfully renegotiated with their bondholders.
Yeah.
And they've completely resolved that Q4 covenant cliff we talked about, the stock just carries extreme liquidity risk.
Absolutely.
So it's a strict wait and see scenario.
Yeah, that's exactly right. The macroeconomic environment, Europe, the energy costs, all of that, and the debt structure, those two things must stabilize before the core business can generate the necessary cash flow to survive.
Okay. That's the read on Mercer. The numbers are tough, the macro is tough, but they have a potential out. But, before we wrap up this deep dive, I want to leave everyone with a final thought on that hyperscaler detail we just talked about.
Yeah, it's fascinating.
Because it really is wild. We are watching a legacy forestry company actively being hollowed out by, traditional macro pressures, wars, freight inflation, local energy policy.
Right.
Yet their strongest lifeline, their best hope for the future, is a massive backlog to build data centers for artificial intelligence.
That's quite the paradox.
It is. And it makes me wonder, are we looking at a future where traditional timber and industrial material companies become almost entirely dependent on the physical expansion of big tech to survive? I mean, it's something to mull over until our next deep dive.
Definitely.
All right. Thanks for listening, everyone. We'll catch you on the next one.